Have you ever wondered what happens to your money after you deposit it in the bank? Most people think it just sits there waiting for you. But the reality is far more interesting. In this video, we'll break down how banks really work and why they play such an important role in the economy. A bank is like a financial middleman. You deposit your money into your account, and in return, the bank keeps it safe and gives you services like debit cards, online transfers, and sometimes interest. But here's the twist. Banks don't just store your money. They use it. How? Through a process called lending. Banks take the money deposited by customers and lend it to people and businesses who need loans, for things like buying a home, starting a business, or expanding a company. So where do banks make their profit? It's all about the difference between interest rates. When you deposit money, the bank might pay you a small interest, let's say 1%. But when they lend that same money to someone else, they charge a higher interest, maybe 8%. That gap is called the interest spread, and it's the main way banks make money. Multiply this by millions of customers, and you can see why banking is so profitable. Here's another interesting fact. Banks don't keep all your money in their vault. In fact, they only keep a small fraction, maybe 10%, as reserves. This system is called fractional reserve banking. The rest is loaned out. This is how banks create credit in the economy. Every time a loan is made, new money is essentially created, boosting economic activity. But this system only works if people trust the bank and don't all withdraw their money at the same time. Otherwise, it could lead to a bank run. So, in short, banks take deposits, lend money, earn interest on loans, and keep the financial system moving. They're a cornerstone of modern economies, but also a system built on trust and smart management. Next time you use your debit card or apply for a loan, you'll know exactly what's happening behind the scenes.